Hello and welcome to the Golden Thumb Rule, where we decode investing principles that stand the test of time. And I'm Shita Janand, and today we are discussing a topic that almost every investor claims to understand, but very few truly implement well, and that is diversification. Well, is your portfolio genuinely diversified, or are you simply holding multiple stocks that rise and fall together? Well, to help us unpack this, I'm joined by Kalpen Parekh, MD and CEO of DSP Mutual Fund. Kalpen, welcome to the show.
Hitesh, thanks for having me.
Thank you so much for taking the time out, Kalpen. And well, everyone talks about diversification, but are most investors actually diversified or just holding multiple stocks in the same theme?
Truly speaking, if you look at any commentary at any point in time in market, and time is over 30 years now, what everyone talks about is what is topical today. And most investment is then polarized around what is topical today. So if in the last few weeks, if tech stocks have corrected because of new developments in AI globally, investors now want to invest in AI stocks. And if over the last 12 months, if silver and gold prices have run up very sharply, everyone is talking about silver and gold. Headlines are also about silver and gold. In fact, most conversations are late, and investors then polarize their capital into late themes most points in time.
Okay.
In investing, first of all, we anyway start late, so we lose compounding. And after that, we invest in an asset class late, and then we lose capital. So first you lose compounding time, and then you lose capital.
Right.
And that is a bigger challenge. So I think diversification is a very important dimension of investing, but I don't think people talk about it as much as you and I may think people talk about it.
My next question is largely around about that theme. As diversification changed in meaning in the last 5 to 10 years, and you explained it beautifully when you gave your first answer, as to how we perceive it. So, given the globalization as well and rising correlation, so your take on that, sir?
So, see, let's remember that what does diversification mean? It is about building a team. The meaning of diversification also means you will own what is not doing well and may not do well in the future. Because when you diversify, you own multiple asset classes, and multiple asset classes do not always have the same path of returns. Real diversification means building a portfolio of low correlated asset classes, which means in the short term, they should be enemies of each other. They could move in opposite directions. They may not talk to each other. They are fighting with each other. But the second condition is more important. In the long term, they should give similar returns, broadly similar returns over a 10, 20, 30-year period. They should be the drivers of earning similar returns, because you don't want to own something which permanently earns poor returns. And just for the sake of diversifying, diversify. So keeping these three things is very important. The underlying asset classes have to be inherently inflation beating on one hand, or they have to be volatility crushing. They have to crush volatility. They have to suppress volatility. That is the first condition. And they should have low correlation to each other, so that the whole portfolio does not rise together or does not fall together. Most often, investor portfolios sink fast and drowns the investor, and he gets out of the game of compounding. So good diversification ensures that portfolios don't sink, and we stay afloat even in periods of sharp crashes. And the third condition then is when you blend this portfolio in the right proportion, the proportion has to be a function of when are you overweighting an asset class.
Absolutely wonderfully explained, Kalpen there. And in fact, that brings to my next questions on the multi-asset strategy. Do you think that is more relevant in uncertain macro environments such as that we are in right now?
I'll give an answer which has been answered 100 times. Never is the macro environment clear.
Okay, sure.
The macro environment certain.
Okay.
World is always uncertain, whether in 2026 when we are talking, 2027 if we talk, 2036 if we talk, 2015 if we had spoken, 1998 when I started my career, nothing is certain at any point in time. That's the first thing one should know. Because nothing is certain, we cannot put all our money behind one area of expected certainty. And what if that certainty does not play out and we go wrong? See, investing, people should understand, is about surviving the game. If we take certain calls and if we go wrong, And if we don't survive the game for the next day, we'll never compound our money. So we have to always invest, keeping in mind that even if my opinion or view goes wrong, I will not get out. I will not lose capital permanently. I am alive for the next day. I can come to the market next day and still play. I'm still
Right.
in the game to get one chance again. And that is possible only and only when we diversify. So the need for multi-asset investing is not about today's market. It was important 10 years back. It was important 100 years back, and it will be important years later also. Timing of the asset classes to a certain extent becomes very important. Multi-asset, which is again genuine multi-asset, would invest across Indian stocks, global stocks,
Right.
precious metals, and bonds. Is a great combination over a 20, 30-year period or over decades. It tends to deliver returns closer to the best performing asset class, but
Okay.
with lower volatility than the best performing asset class. And something will always do well in the portfolio, and that's the beauty of multi-asset. But the time horizon for multi-asset investing still has to be a 5-year time horizon and not
Okay,
one.
absolutely. And in fact, beautifully explained that if someone is getting into a multi-asset strategy, the minimum time frame which one should have is close to 5 odd years. And tell me something, how often should the asset allocation be reviewed according to, should be annually or tactically? Can retail investors successfully time the asset classes? Mm,
So if you have the wherewithal to understand markets and cycles,
mm,
think of balancing either once in a year or when some asset class, gets drunk or, goes to extremes. Uh,
sure,
that is when, existing weights go off track or go haywire. Either they go too low or they go too
right,
high.
right.
Isn't good to say, okay, let me think of rebalancing. Let me re-establish or revisit the setup. The setup has changed because of which that asset class has run up so sharply.
Mm, mm,
So just to again give you an example, very long-term returns of precious metals over the last 30, 40 years is between 8 to 11%. If in the last 1 year they've delivered 150%, or in the last 2 years they delivered 300%, which is
uh,
far away from their long-term returns. Two things would have happened. It is a
mm,
natural. They have, completely recovered from their below average returns to above average returns, and that is why
mm,
they were great returns.
mm,
And the percentage weights would have gone off track. So, for example, I give you my own example. I had around, let's say, 10% in precious metal and related
okay,
portfolio
right.
18 months back. That 10 almost became 20
Mm,
because it ran up very sharply. And the other components were sideways. So the other component remained lower and kept on becoming lower, and this became 20. Now I
mm,
have to revisit that. In today's setup, should I have 20 in gold and silver? Now, all headlines will nudge me to increase because what are headlines saying? That inflation aa jayega, so precious metals will do well. Uh,
yeah.
Central banks are buying. They were buying 4 years back also.
Mm,
Or the world is fragile. World was always
mm,
fragile. सेंट्रल बैंक्स आर प्रिंटिंग मोर मनी वो तो 2008 से शुरू किया है आज क्या चेंज हुआ है तो
right.
आज जस्टिफिकेशन आता है
हाँ,
but unless there's a new input to the information that was available 1 year 2 year 3 years back for
right.
me to say, okay, 20 is also fine, then it's okay. But if there are no new inputs and the valuations have become unfair, it is
Mm,
time for me to bring down that 20 slowly back to 10, or
okay.
the first step, take it to 15.
Mm,
Or
mm,
I say that, now the world has changed for good, for bad completely. Some
yeah,
new dimensions have happened, and this 20 is less, and I need to take it to 25. In these conditions, I would do that, which is, chasing an asset class, which the whole world is chasing right now.
mm, mm,
बहुत सिंपल है कि अगर कोई ट्रेन फास्ट मूविंग ट्रेन है प्लेटफॉर्म पे रुकी नहीं है और उसको आप चेस करोगे चढ़ने के लिए यू विल
mm,
100% accidents. And the same happens with asset classes which are running very fast. So
uh,
rebalancing should
uh,
then underlying asset allocation, becomes haywire.
right.
So you have it annually because typically in a year things don't change so much.
There's a lot of returns that US markets have also given and the other European markets have given compared to India. But at this age in time, should portfolios be globally diversified?
Great question, Kshitij. See, I think the framework of diversification should not be around India or China or US or Russia. It is not that countries make money. And if you try to choose a country, in a country there are 500 more stocks. So
Mm-hmm.
I have to say that, okay, US looks good. Now, how do you decide what part of US looks good?
Sure.
Uh, it's great intelligent statement, but of no relevance, of no
All
value
right.
add. I think I'd rather give you a framework which is
Mm,
of value, which has which has actionable value. The way we think about diversifying is the principle should not be diversified. The principle is you are buying asset classes at fair price or less than fair price. When we think of diversifying globally, it's not about a country because every country will have at all points in time a bull and bear market going on. Just giving you one statement is not complete. So, important thing to learn is what type of companies generally make money over medium to long period of times. The answer is businesses where free cash flows are rising and you're buying them at fair price or cheaper than fair price. That is a better principle to aim for.
If you had to design a 2026 ready multi-asset portfolio, what should that look like?
So basically, my approach always is, I'm building for long term. In fact, 5 years is not necessarily long term, but it's medium term. But if I'm building years and above, I would have growth as a key part of the portfolio, which means
Okay.
stock, assets which are free cash flow. And I would want defense in the portfolio, which is generally gold and precious metals act as defense and stocks don't do well. Today, we are in a special situation where the defensive part has become very aggressive, which is precious metals. It is very likely that they may go through heightened volatility. There are periods where gold and silver for 5 years and 10 years have given zero returns or even 30-40% falls. So it makes me a bit confused right now. But my portfolio today would be around, equally split between Indian and global stocks. Let's say 33%. So that's 60. I would keep around another 25% in bonds, which are in India, the bonds earn between 7 to 8%, and they can be put to work when there is higher volatility in stock or in precious metals. And around 5%, I would keep it in precious metals. That's how I would build my portfolio today.
Right. And I'm sure the last question is equally interesting, and that is the biggest mistake which investors make while diversifying.
I think, like I said, this ties up to the first question that I don't think investors genuinely think about diversifying. Only framework which generally drives all of us. And I'm myself guilty of this. When I started my career, the first 10 years, I've done the same thing. So, which is, आप website पे आके देख लो last 1 साल में क्या अच्छा हुआ है, and you go and you assume that what has done very well in the last year is likely well in the next year. But no one understands the concept of cyclicality, mean reversion. Those are things investors have to really learn when they are building portfolios, or they should start, searching for a good advisor who will guide them of these principles. The other a mistake that more often we make is let's say many investors may have 20 mutual fund schemes. Each scheme is ultimately investing in similar 40 stocks. So through 20 schemes, you are going to similar 40 stocks. So index fund your outcomes won't be any different. People can make better returns than mutual funds if they know how to build portfolios. But just blindly building portfolios without knowing rules of the game, without knowing whether that company has proper accounting, are numbers right or fudged. Many portfolios, we had done this exercise 2-3 years back. The stocks which had the largest number of retail shareholders were the companies which in the last 5 or 10 years had not generated return on capital above cost of capital. These are learning points for investors. We always encourage investors कि जरूरी नहीं कि आपको पूरा पैसा म्यूचुअल फंड में डालना है. If you can learn, you can definitely do better than us. By all means, do that. But don't do injustice to your money by investing without knowing some of the rules of the game.
Absolutely well. That's a powerful note to end on. Diversification isn't about quantity, but it's about balance and behavior. Kalpen, thank you for sharing these insights. And to our listeners, take a closer look at your portfolios. Are you truly diversified or just diversified on paper? And this is Shraddha Janand, and you're listening to the Golden Thumb Rule. Until next time, invest wisely and stay disciplined. Thank you so much for taking the time out, Kalpen.
Thank you. All the best.